Welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sumaira Abdi. In an effort to educate communities of retail investors in this entire series, today we're at the offices of the Commissioner of Police, Navi, Mumbai at CBD Belapur, and with us are a whole host of police officers. Also joining us to give them advice are Rajiv, Anand, MD and CEO, Axis Mutual Fund, and Harshvardhan Roongta, a certified financial planner at Roongta Securities. But before we get to the question and answers with our guests and the focus group that we have gathered here today, I'd just like to take you through the research that we had done across various cities with police officers of various cadres and ranks. We found that 71% of the police officers were not at all comfortable investing in the stock markets, while 23% were somewhat comfortable. And this is something which is affecting their risk profile, is the fact that most of them were single income families, which means that our target groups were the only earning members of that family having 3 or more dependents. We also found that half of those we had surveyed preferred to invest in bank FDs, and about a quarter of them opted for investments in insurance products as well. So with a risk profile like this, it's not just their financial fitness that we felt they needed to focus on, but also their physical fitness, which is something that we felt they needed to focus on. So we'll be also dealing with their physical fitness aspect, part of it later on in the show. But before that, let's get to our guest. Rajiv, let me come to you first. Not surprising that the participation in the equity markets is so low, but I'm surprised that out of all the communities that we've met with and interacted so far, this is one community which does not even invest in mutual funds or any investments of that matter. For a single income family, I realized that they wouldn't want to invest in equities per se. How can equities or mutual funds be incentivized for people with this kind of a risk profile?
I think it's about budgeting. You have an income, you have your expenses, you have EMIs, you should buy an insurance, and I think after that is really what you have is savings. I think most Indians today put their money away in fixed deposits. Yes, capital is absolutely safe. No bank has ever gone bust in India. However, savings in fixed deposits is getting killed by 2 factors. One, the return is taxable, and 2 is it's not even beating inflation. I think in that context, it does make sense, and this is not necessarily to this group, but to the larger audience as well, that it does make sense to move some money away, from fixed deposits into slightly more riskier assets. And I think there is a myth that mutual funds are for the rich. You can actually buy a mutual fund for as little as 1,000 rupees today. So you can start investing, even 1,000 rupees per month over a period of time. And that will, in a sense, start to build a corpus, which, if not anything else, will at least help you start beating inflation.
Sure. And, Harshvardhan, I want to ask you, because you've dealt with a lot of people with a similar risk profile. I want to begin by asking you, what's the one common investment mistake that you've seen, and how can it be rectified?
Well, when you look at an investor profile, you'll have people with all kind of preferences, which they have basically been inherited with. There are some things which come through generations into their culture. So, we do hear people saying that equities, my family has never invested, so I am not going to venture out into it. My forefathers told me equities is not for people like me, and so on. So what is important is that once a person is living in a particular, century, if I may put so, he needs to understand that there are certain things which he needs to do which are relevant to present times. In India, yes, we've had situations wherein there were a lot of scams. Okay, if I may put that word, a lot. But things are changing now. Regulatory things are turning around. We're seeing more stringent norms. So there needs to be confidence which needs to be coming in at this point, keeping in mind that regulatory environment has changed. Now, coming back to this specific group, I mean, we know that there is a large number of people who are earning less than 5 lakhs. That's the data that we have. And a majority of them are less than 29 years of age. And again, so average age of the group that we see is about 30 years of age. So if age is to your side, and if you're comfortable understanding what kind of products are available today in the industry, listen to it with an open mind, accept it with an open mind, and if they can allocate some funds out of their total corpus, it does work for them. Another reason why it is even more necessary, if I may put so, we are seeing that the large numbers have an income or annual income of less than 5 lakhs. Secondly, if you are going to invest into a product which does not even beat inflation, then you're really going to be struggling very hard to meet your goals. So with that less corpus that you have, you need your money to work harder. Unless you do that, it's going to be very difficult to achieve your targets. So one portion of your investments does need to go into areas which are high risk and high reward. But as long as you have restricted it to a small portion of your total corpus, it should not be a cause of concern.
Sure, so it doesn't matter what's the amount of investment that you're making, but a percentage of that needs to go into assets that will work for you give you much higher returns than other assets would. So it may not be a very large percentage, but a percentage for sure. And Harshvardhan, Rajiv raised a very interesting point. He said, invest in the century that you live in. So I want to ask you, there's this, myth about bank FDs that we've been talking about, and I cannot, emphasize on that enough. This whole myth of bank FDs being safe when they're not even safeguarding the value of your capital.
Absolutely. I think bank fixed deposits is saving. And I think you have to differentiate between saving and investing. Yes, in a bank fixed deposit, your capital is safe. But the return that you're getting is actually, pretty much worthless as you go into time. And the other is of course taxes, and there's nothing much that we can do about taxes. Every rupee of income that we have to pay taxes on. And I think we must look at investment from as a return on post-tax basis. What are the most efficient tools that are available such that I'm able to mitigate or minimize the tax that I'm paying? I'm already paying a very large amount of my salary as tax. I certainly don't want to pay too much more on the interest or investment income that I'm making. And there are numerous tools there. There's Section 80C which is available, which gives you tax breaks. Use those instruments, public provident fund and so on and so forth, which gives you tax-free income. You utilize those to the maximum, and in that sense, at least your post-tax income is beginning to go up. And in a sense, it's a subsidy which really the government is giving back some of the taxation that is taking from you. Utilize all that and then start to use some of the sort of market instruments that are available.
Sure. So, like they say, death and taxes are the only certainty. So I suppose one of the certainties, at least we can try and minimize, and till we arrest inflation, so to say, let's try and beat that. But I'm not the one who's going to be asking all the questions. I'm sure there are members in our audience who are waiting to ask questions. So let's go ahead. Who wants to ask the first question?
I have very limited earning, and I'm individual in my family earner. I just want to ask you, I go for family security or I go for the investments where I can raise my money. So which segment is best for me?
When you do financial planning, you need to make allocations on both the aspects. You cannot say that I want to only protect my family. You cannot say that I don't want to protect my family, but I want to have only investments. You need to have a balance of both, depending on how much is the protection that you want to provide. Now, suppose you want to say that if I am not there anymore tomorrow, that's the security part. What happens to my family? So what you do is first identify the quantum of money you want to make available to your family. Suppose now you say that I want to make available 20,000 rupees every month. Let's take fixed deposit as a product, if that is what you are considering. So if you have a fixed deposit in bank for 50 lakh of rupees, your family can get 20,000 rupees a month. Now the biggest question, where do I get 50 lakhs from? Right? That is how much is the insurance that you need to buy. You need to have an insurance coverage of 50 lakh of rupees, which in case something happens to you, your family gets that money, And you advise them now itself that once my insurance money comes, you put it straight only into a fixed deposit. Don't do anything else. And you will get 20,000 rupees a month net of income tax. Now, 50 lakh of rupees insurance I want to buy. It will be very expensive. Not really. There are different kind of insurance policies which are available. One is a savings based, the kind that you've seen, endowment, that you make a contribution. If nothing happens to you, you get back some money at the end of 20, 30 years. There's another form of insurance called a term insurance policy. You buy a term insurance policy, you pay the premium, nothing comes to you if nothing happens to you. If death occurs, the family gets 50 lakh of rupees.
Okay, is anyone else who has a question? Sure.
Whatever pension plans are there, they are going to give us a lump sum of money, not a monthly income, monthly source of money. With this inflation and this recession, naturally, I won't be able to cope up with that, with my whatever amount I am getting in the pension. I won't be able to cope up with that in the running future. So naturally, I am thinking about the plan which will give me sufficient amount in addition to that my pension plus. But now our new generation is more worried about it because they are not going to get pension in the future. So can you suggest any plan for them which will give them a good amount of monthly income after their retirement?
I would strongly urge each one of you to use the national pension scheme. May not necessarily you, sir, who are close to retirement, but at least the younger people. It is a very good option to create long-term savings at a very low cost, and which in a sense will provide for your retirement in the future. It is absolutely safe, government run. So what you're basically doing is put money into the national pension scheme. There are three types of options: one which is only invested in fixed income, one which is invested in fixed income and equities, and one which is invested only in equities. You can choose any of those options.
And what about someone who's close to retirement? Is this a product that you'd recommend to them as well, or is there any other product available in the market for them?
I think once you have retired, really it is, like you rightly said, it is about creating a corpus and creating a reasonable level of interest which will hopefully beat inflation. Just putting money into fixed deposits is not going to be enough. You will have to take some risk on your portfolio. Need not necessarily be the entire portfolio, maybe 15-20% of your portfolio. You put that money away in equities, you may not necessarily get a return on that on a yearly basis, but if you look at it over a 3 to 5 year period, returns will be reasonably attractive, such that the entire corpus would have beaten inflation.
And the good thing about retirement is you'll have time to track the markets. So I suppose you could be a more active investor. But let's take a very quick break. We'll be back in just a bit. On the other side, we'll get into more voices from across the country. Stay with us. Welcome back. You're watching Informed Investor, and today we're coming to you from the offices of the Commissioner of Police, Navi, Mumbai at CBD, Belapur. But before we get to members of our audience and hear their queries, let's go across to Delhi. Joining us is Maxwell Pereira, former Joint Commissioner of Police of the Delhi Police.
My name is Maxwell Pereira. I'm a retired police officer. I am not an aggressive investor. I'm a cautious investor. I don't like to lose money, and especially not at a retired stage. It is sad that I started investing very late in life. I didn't have much opportunity. I think you need money to invest. No money, no invest. I did dabble in stocks and shares, but not as a professional, not as an informed investor. To be an honest, good investor in stocks and shares, not for people like me who had no time for it, who had no inclination to study the market. The investment climate has been really messed up with by this country in the recent times. Common man like me, can he have some hope for investing, or are we going to stagnate? Are the mutual funds in this country ever going to lift their head again? Is equity going to have some standing? I would love to have some answers to these questions.
There is a very valid point that Mr. Maxwell Pereira has made. You need money to invest. So no money, no investment. Well, that is true. If you do not have money, you cannot make investments. But you need to have lots of money to start investing. That's the question. As we've discussed it earlier as well, that you can start making investments with 1,000 rupees a month. You do not need to have lots of money to start investing.
You don't have to be an expert on the on equities. You don't have to pick stocks. There are professional fund managers, mutual funds. That's what we do for, for a life. You can come to a mutual fund and you can open what are called systematic investment plans in any good quality diversified equity fund.
Yeah, and most importantly, find an advisor who you trust. But let's go across now to U. Rama Mohan. He is the SP Cybercrime CID Andhra Pradesh Police, who joins us now with his question.
For my investment was only on FDs, gold, and of course real estate. Regarding mutual funds, I burnt my fingers earlier. Something like in 1992, huge loss I have come across due to Harshad Mehta's issue. Later on, I thought it's not my cup of tea. I would like to ask, do you want me to go for good investments in any share or mutual funds? How do I go about it? If I want to invest short term, which is better one? And if I want to invest for long term, which is better one?
Okay, I want to come to you, Rajiv, first, because you've been speaking about the discipline of investing, and here's someone who says that they've burned their fingers once and therefore probably missed out on the good times thereafter.
So there are two parts to this answer here. First, there are numerous types of mutual funds. Mutual funds is not equal to equities, first and foremost. There are various types of mutual funds. At the safest level, there are what are called liquid funds. Liquid funds are like your savings accounts. However, where your savings accounts today give you 4% returns, today liquid funds are returning almost 9%. And the use of these liquid funds is almost as easy as savings accounts. And then there are fixed income funds, which are like fixed deposits. So there you're taking slightly higher levels of risk, but typically the returns are slightly better as well. And then there are mix of equity and fixed income, which are typically either what are called monthly income plans or balanced funds, where there is some element of fixed income or debt and some element of equities. And then finally, of course, there is diversified equity funds. So what the gentleman has invested in is in diversified equity funds. And yes, clearly in what inevitably happens with retail investors is that they buy when the newspapers are talking about the fact that equity has delivered 20, 30, 40% returns. They typically get in at the wrong time and get out at the wrong time. Equity is not a casino. Equity is an asset class. You are buying a share in a particular company. You are becoming the owner of a particular company. So if you think like an owner, if you think of equity like an owner, you would want to stay invested for as long as possible. The longer the better. And equities tends to give you returns not in percentage terms. It gives you multiples. So your 10 can become 20, 20 can become 40, and so on and so forth. But for that, you have to have patience.
Before investing, have an asset allocation plan in place. If you have that in place, then even if the markets don't do well, you do not need to worry. One more point which Rajiv made was that when you're investing into shares, do not think it is a casino. Yes, it's a very valid point. Look at it from a part as if you're owning that company. Share is what? You're having a share in that company. That is why shares. How do you select companies? If you do not want to, you do not have the technical, infrastructure to see what companies are doing good or not, you see what products you're using. We are using Colgate. There is a company which manufactures it. So you can buy shares of Colgate. You all know that how many people are using Colgate, who's using Close-Up. The number of cars that you see on the road. Maruti, you see the maximum number of cars are Maruti. You can buy Maruti shares. You're owning the company in that percentage or in that quantum of shares that you have. So the businesses which you understand, if you buy into them, you can stay invested for 10 years also, 20 years also.
But anyways, let's open the floor once again and get in some more questions. Who'd like to ask a question? Sure.
Which is a good mutual fund in a market for a long-term investment?
In mutual funds, they have separate categories. In equities alone, they have one category which invests into any sector, any company. These are called diversified equity funds. There is another sector, there's another fund which is, say, a large cap fund. which will invest into companies only which are very large in size, above say probably 10,000 crores, which the company which has a market capitalization of above 10,000 crores. Then there is another set of fund which has a large and a mid cap, which will invest into companies which are above 2,500 crores and above 10,000 crores. So there are different categories of funds that are available. Which one suits you? You need to see that. Are you comfortable with only large companies? Okay, if you're comfortable with large companies, you select a fund which is large cap in nature, offered by a very good mutual fund house. That is what we mean, the asset management company. After that, once you've decided what you want to do, you seek an help of an advisor who will then help you pick the best fund of that category.
So as a new investor, I guess perhaps a few Sundays can be devoted to some amount of research, all of which is available on the internet, on the websites of the mutual funds, as well as a lot of websites that deal with the entire range of mutual funds. So it's a good Sunday exercise to begin with. But let's take a very quick break. We'll be back in just a bit. On the other side, some more voices from across the country. We'll also open the floor once again to questions from our audience. Stay with us. Welcome back. You're watching Informed Investor. We're coming to you this weekend from the offices of the Commissioner of Police, Navi, Mumbai at CBD Belapur. Before we get to the members in our audience, let's go across to Brijesh Singh, Additional Commissioner of Police, Mumbai Police.
I am Brijesh Singh. I am working as Additional Commissioner of Police with Mumbai Police. In a way, police is a conservative department, so one doesn't go for very risky kind of investment options. Secondly, property also has become very expensive. And with a transferable job, normally one doesn't know where one would be in the next 3 years, 4 years. So it's also very difficult to purchase property. So I think there is some kind of, I should say, a financial blindness in police in general. Are there ways where you can plan with meager resources right from now for education of children in future, let's say in a 5-year, 10-year perspective?
Mr. Singh asked about that he had a particular goal, the education of his children. Is investing for a specified goal with a specified time frame different in any manner than investing for, say, wealth creation?
There is a thought which has come into your mind that 5 years, 10 years down the line, I need to save money for my child's education. You've given the first sign of good parenthood. Now, how do you go take it further? So second question you have to ask yourself is that how much money do I need 10 years from now for this particular purpose, which is education? Keeping in mind inflation. Today the cost is going to be X, 10 years later the cost is going to be Y. So once you have got a figure that you need so much money 10 years down the line, then you do a backward calculation. If I need say 20 lakhs after 10 years from now, how much money do I need to start saving from today? So then you will get a figure that you need to be investing for this particular purpose. So in that form, it is different from wealth creation. Wealth creation is a more broader perspective, saying that I need to have a better lifestyle tomorrow, for which needs to be sustained with the help of a corpus which I will generate, which can be 10 years from now, which could be even 15 years from now, as long as I'm going to work. Education, for that matter, is very specific. Once your daughter or your son passes out from graduates from college, you need to go for higher education. So it's very specific and time bound. So the earlier you plan, the better.
So as much as possible, I suppose, try and find as many goals and allocate your resources for them from the very beginning itself. But let's also now go across to Kolkata. Joining us from Kolkata is Sunil Kumar Panja, who's a retired inspector of police.
I am Sunil Kumar Panja, a retired police officer from Calcutta Police Force. Before my retirement, I used to invest in compulsory provident fund, NHC, insurance and mutual funds. But after my retirement from the service, that is on post-retirement period, I mostly invest in FDs in the bank, mutual funds, also invest in share market on long-term basis, but not regularly, as I am a retired person and can't afford the amount required for the purpose for investment. I would like to ask the experts that being a retired person, how can I build my portfolio with limited resources? Also, IPO market is dull for a pretty long time. For a long-term investor like me, should I buy at IPO price or to wait for market performance to enter.
Suppose let's start with the IPO question first, because that would get taken care of quicker. Rajiv, do you want to take that?
I think there is no magic or miracle in an IPO. IPO is like any other company. Today there are 4,000 or 5,000 listed stocks. Why do we think that the IPO is something which is so different and beautiful as compared to these 4,000 or 5,000 stocks? I mean, remember that it may not, no promoter in this or any other country is going to give you his company cheap. Yes, there may be a bit of an what is called an IPO pop, which means on the date of listing you may get a little better return. But if you're really playing for that little better return on IPO date, you're speculating. That is not investing. You may or may not get it. So my argument here would be that treat IPOs like any other investment opportunity.
And the other part, Harsh, I want you to tackle that, is how should your style of investment or perhaps your allocation towards your investments change as you retire?
You need to know how much you need monthly even after retirement. There is some kind of pension which is going to come in from the government, and there is a corpus which is coming to you. So pension plus the returns on your investment should be equivalent to your monthly expenses. That is the first rule. Now, to secure that, you need to have your money into, say, fixed deposits or debt funds, which are non-equity. So there is no risk you can take with that much amount, which is very clear. So if you do not want to take any risk, you need to invest into areas which are safe in nature. So whatever you're left with after securing your monthly expenses, invest into, say, equities for that matter. So that 10 years later, when the inflation has caught on, you can redeem those equity mutual funds or equity investments, add it into fixed deposits so that your interest income, subsequently your monthly income, rises. So in that context, there is no fixed formula. It is wrong to say that a retired person cannot invest in shares. It's wrong to say that. So it entirely depends on the facts of your matter. What applies to gentleman A will not apply to gentleman B.
All right. And let's also get in a question. I believe you had a question. Go ahead.
Please suggest us the good health plan which can cover all hospitalization expenditure and almost all diseases in minimum premium.
There are a lot of options available in the market right now. You have a new launch, Tata AIG, General Insurance has launched Medi Prime. That's a very good policy in terms of its terms and conditions. Apollo Munich, Easy Health is another product which is nice in the market. Now, the general insurance companies, the public sector units, the New India, National, United, Oriental, they also have a Mediclaim policy, but there are certain issues that they have limitations on the room rents, 1% of the sum insured. So going into a little technicality, if you're comfortable with the public sector enterprise, then you may choose from amongst the four. Or else today, I mean, you can certainly consider a Tata Medi Prime or an Apollo Munich Easy Health. So these policies are very, very flexible in nature, and they offer much more benefits.
All right, let's now hear out A.K. Sharma, the Commissioner of Police, Navi, Mumbai.
It is important for every policeman to save. It is more important than even other salaried persons, because the job is stressful and there are eventualities in the police work which often does not arise in the other salaried jobs. The salaries of the policemen have improved over the years. Earlier, all the salaries were paid in cash to the policemen, so they'll get on 31st or 1st, all cash in hand. Now all policemen are being paid through their bank accounts. So necessarily the salaries goes to the bank account and he takes out money as and when required. That's why he is learning to the banking system also. We often hold training classes, teaching classes where we tell them the importance of saving. We tell them that as long as the money is lying in the bank, you will get some interest. You should put it in the FDs and mutual funds. Though I'll say this culture of equity is not much popular in the police now yet. But I think in due course it will also develop. At the moment, people tend to put money in the FDs or at best mutual funds. The job of the policeman is very stressful, long hours of duty, and often risky also. So health is very important for the policeman. In fact, I'll say that health is inbuilt in the policing. An unfit policeman is as good as no policeman. So we tend to give a lot of importance to the fitness of the policeman. We tend to have yoga classes for them. We tend to have stress management classes for them. And increasing trend is that they are health conscious.
So clearly for our target group, fitness is as important as planning their investments. So on the other side, we'll take a check on how best they can plan for their physical requirements. Stay with us. Welcome back. You're watching Informed Investor. For our target community this week, which is police officers, physical fitness and financial health go hand in hand, because as a majority of them come from single income families, the responsibility of all their financial investments rests solely on our target group, and therefore their physical fitness is of prime importance. So joining our financial experts now, we have Kalpana Mehta, who's a yoga instructor at Fitness First and specializes in therapeutic and fitness yoga, and also works with cardiologists as well as orthopedic doctors. Thanks so much for Kalpana for joining our experts here. But before I get to my question for you, I want to just take you through this research that we had conducted, which found that by and large, those police officers who we had surveyed, they were equally divided between those who exercise daily and those who didn't, and also equally divided more or less between those who monitored their diet and dietary requirements and those who didn't. So what advice can you give for someone for whom monitoring their health is critical, because the financial responsibility rests on them?
Physical, mental, social well-being is health. Yes? Now, if I say mental health, you need to take care of emotional health as well as your energy health. If energy levels are low, you cannot enjoy good social, emotional status. And if your emotional status is not good, you will not enjoy anything. And at that level, we are never ever aware. So we have to fix certain programs, certain regime for our health. Now, if you see only physical health, if you are working out or you are doing some kind of cardiovascular exercises, your heart rate is high, the dormant arteries in the heart are open, and there are less chances of cardiovascular problems, which are very, very prominent nowadays. One thing which I have learned in your training, there is also a simple march past. This simple march past will help you to improve your cardiovascular health. So at least take out some time whenever you start your day, maybe in the morning, maybe bandobast ke baad, in noon time, you can do little march past of 15 to 20 minutes to improve your cardiovascular health. At the same time, you have so many things in the house, you can do little kind of weightlifting. And never forget your energy and emotional health, which will come by the breathing techniques. Keep a regular checkup on your health.
And perhaps this will also help in bringing down your health insurance premiums, which we've been talking about. So that's another added advantage.
This is a very, very wrong attitude actually. When I'll get sick and then I will use this money. Why don't you invest this money to get
into
good health?
Health? Yeah, I'm sure there are people here who have questions. Go ahead.
What are the benefits of Anulom Vilom?
Anulom Vilom is it's just altering the function of brain, and it brings a balance in your brain. If you study that your right nostril, which is called Pingala Nadi or Surya Nadi, it takes care of your left brain, because the energy channels are this way, and the left nostril take care of your right brain. If you see the function of right brain is the brain of creativity, intuition, spirituality, introversion, and the left brain is for logic, all the material things which you enjoy, or the arithmetic which you do, and all the justification, analysis, it helps that. It's a very, very good pranayam to improve your cardiovascular system. At the same time, it also improves your immune system.
Thank you so much, Kalpana, for joining us. And I'm sure this has been a great help to our audience here. But we've been talking about also investments initially, and we've been talking about how your portfolios can be structured. So Harshvardhan would like to take you through a portfolio, and he'd analyze that portfolio for you, and I'm sure that would also help you in structuring your own portfolios thereafter. Take off.
Well, this is actually a query posted on moneycontrol.com, And as an initiative, we have picked up one lucky, say, a person who's put in his query, and we will actually attempt to solve that query. The query ID on moneycontrol.com is 1200. User ID is draj2400. He's aged 33 years of age. Now this person has some investments made into stocks. He's invested into shares directly to the extent of about 50,000 rupees. In mutual funds, he has about 72,000 rupees. And in ULIPs, that is unit linked insurance policies, he has about 1,96,000 rupees. Now he has goals that in the next 5 years, he wants about 40 lakh of rupees for his to buy a new house. Next 15 years, he needs another 40 lakhs for his child's education. And after 20 years from now, he needs about 2.5 crores for retirement. Now this is his requirement. So keeping all his finances in mind, we've just made 2 recommendations to him. One, for his house, he's got only 5 years left and he wants to accumulate 40 lakh of rupees. 5 years is too less to plan for such a large corpus. So there is where we have another product available from financial institutions. It's called a housing loan. So what we are recommending to him is that he has certain investments which I mentioned earlier in the form of stocks, mutual funds and ULIPs. He can liquidate them after 5 years and use that as down payment for his house. The balance amount, he can secure a housing loan from a bank and then plan out accordingly. That's the best he can do within the present circumstances. Regarding his children's education and retirement, which are 15 and 20 years from now, what we can recommend to him, this could be a case for all of you as well. So he needs to start making one common pool of investments in which he needs to invest 16,000 rupees per month, which after 15 years, if he take a long-term equity returns of 14%, would become about 96 lakhs. From here, he needs only 40 lakhs for his child's education. He removes 40 lakhs, lets the balance amount be there, and continues making the 16,000 rupees. He doesn't stop that 16,000 rupees. So after 20 years, that is when his retirement is due, the likely corpus that he will accumulate will be about 2.65 crores, which he can probably invest, as we spoke about post-retirement. He can invest it into, say, a fixed deposit or another safe instrument depending on his financial situation at that point in time, and from which he can secure a monthly income for the rest of his life. So that's how anyone, not only this gentleman, but anyone can plan. If you have foreseen, if you have made a plan for yourself and set yourself goals. So if this gentleman can achieve it, I'm sure all of you can.
Just before we end, Rajiv, just one final word from you. I know I'm going to put you in a corner on this one, but I want you to give our audience perhaps just the top 5 things to look out for when they're investing in perhaps an equity, because most of them have shied away from equities from so long. So just the top 5 things that they need to look out for.
When you're building a equity portfolio, number one, don't put all your eggs in one basket, which means that if you have 10,000 rupees, don't buy just one stock. I mean, buy a diversified portfolio of at least 5-6 stocks that are available in the marketplace. 2 is, I'm assuming here that you want to build a long-term corpus. Buy into large cap companies, companies which are part of the Nifty 50 or part of the Sensex, or at least part of the top 100 companies in this country. Because I think as you keep going down the order in terms of the size of the companies, the risk increases, and your understanding of those companies, you have to do some sort of analysis. 3 is, do not buy on tips. Do some basic research before buying a company. 4, think long term. Right? Do not think that I'll buy this stock at 100 and sell it at 120. Think long term. The probability that you will get a positive and handsome return only increases. And believe in the Indian growth story, and most important, have patience. I think equity, one of the biggest virtues that you need to make money in equities is patience. And I think for that, I would also recommend some yoga, which will increase your patience. Not only will improve your physical health, but your financial health as well. If you can't do all this, there is a simple way to do it: buy equity mutual funds. Right? It is, like I keep saying, you're outsourcing all that hard work
two professionals, and it is their job every day, every hour to be able to deliver that long-term return to you. So you can then go on with your life, you can spend time with your family, you can spend time on holidays, etc. But there is somebody who's working day in, day out, 7 days a week to be able to let your money grow. So there are really two routes. It really depends on what works for you.
And Rajiv's also got his breathing right, so he's going to be totally aware when he's making your investments. So on that note, let me begin by thanking our experts. Rajiv, always a pleasure to have you. Thank you so much. Harshvardhan, thank you so much for your time. And Kalpana, thank you so much for coming here and adding an entirely new flavor to our series. Thanks so much, and thanks so much to our audience for your generosity of time and for your patience. And we hope that Informed Investor has been of some service to you. Thanks so much. So here's where we'll wrap up then, with the promise to see you next week. Do stay with Informed Investor and do keep writing into us. Thanks so much for watching.